Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. And what I want to talk about today is oil, peak oil, the market conditions that happened in the 1970s, and the market conditions that are coming up today. And I'm going to draw some similarities between the two conditions. I call it market conditions. So the way that I view the markets is I use ratios, market conditions, and some technical analysis on the big picture. That's really where I drive my I should say that's where I get the data from, and that's where I drive my investment decisions and strategies. It's from those, I call it the three pillars. And I'm drawing conclusions to those areas. So it's ratios on where that basically tells us where money is and isn't in terms of assets. If money is in a certain asset, it would be priced historically high. If money is not in that asset, it would be priced historically low. When certain market conditions come up, the ratios move in certain ways based off of changing market conditions. So during certain environments, I call it market conditions, those ratios reprice themselves. Some become inexpensive to, or I should say, inexpensive to expensive, or undervalued to overvalued, as the market conditions drive money flows for certain patterns or certain ways. Those money flows is what we're chasing. We want to front run those money flows. And it's the market conditions that ultimately decide where money goes. And maybe I'll say that a little bit differently. I'm going to say it differently this way. The people in society, when certain pressures are applied to people in society, they get scared emotionally. They try to make different decisions, and they're going to be forced with different decisions to make during certain conditions. For instance, people are going to behave differently buying a house at very high interest rates, perhaps, than at a time with very low interest rates. People will change the way that they view, let's say, an SUV in a very high price gas environment than, say, electric vehicles. They're going to change their viewpoints on these things given certain market conditions. The pricing of assets are determined by the market conditions. The market conditions, if something is very scarce, it's going to be expensive. Scarcity is a market condition. The price is the resultant. The ratio is a resultant. The price is a resultant of the market condition it's in. So if you're in a oversupplied market, which is the market condition, that asset becomes cheaper, or that commodity or whatever it is, when you've got too much of it. So what I'm doing here is I'm looking at the market conditions that basically led to the 1970s. The 1970s was a very highly inflationary environment. We had lots of liquidity, and I'm going to show you similarities to the market conditions today. I don't necessarily think that the 1940s are market conditions. I think we're more like the 70s. This presentation is going to kind of get into that. So let's just dive right in here and give you my opinion. So I put together this presentation here. What I put here is the Hubbard's peak prediction versus actual oil production in the United States. So in the United States, in 1970-ish, 1968, 69, 70, was somewhere in that time frame, the United States hit peak oil and we started to decline. The prediction was this dotted line. The actual is the solid line. This solid line here, we started to decline in our energy output. We had a very large price increase in oil, which I'll show you later during this time frame. That decline transferred liquidity in the system into oil and commodities and prices. The cost of energy is the prelude to higher we'll call it consumer price index numbers. I was going to say commodities, which is true, but it's going to convert into higher consumer price index numbers. Now, this is what it looked like when in the 1970s. We had a peak here and we declined. This put pressure on oil prices in the short term in the United States to rapidly go up. And you can see what happened later on. We declined, and then we went into shale oil in the mid-2000s. This is the shale oil boom, which I don't know if this is sustainable or not forever. It will eventually peak and go down as well, just like everything else. But this is what we get. This is what the market conditions were in the 1970s. We hit peak oil in the United States, but we had capacity in the world for the Middle East. So we weren't at pumping capacity of the entire world. We were at pumping capacity of the United States, which triggered a crisis or a problem in the United States, and it was contained to the United States only. And that was one of the problems in the 1970s that led to high inflation. Here's world crude oil production. We had peaked in 2018. We declined some and we declined into 2020. Is this the peak? I don't know. But I can tell you this. If it is the peak, or if we're close to the peak and we can't grow our GDP, what you're going to see is oil prices go up dramatically, because the world's going to want more oil than it can give. And that is very similar to the 1970s in the United States. The United States wanted more oil than what it could give because it reversed on them. That created obviously a gigantic spike in oil, but it created a lot of inflation during that time frame. We had stagflation during that time frame. Why did we have stagflation? Stagflation is where you have inflation in the system that, in my opinion, is driven by an energy constraint, where the world wants to grow but can't grow, at least in the United States here. I know it's localized for this particular, in the 1970s, it was localized to the United States. So we hit a constraint where we couldn't grow. That is where the stagflation portion, I think, comes from. It's not being able to grow, and you've got inflation, which is driven by energy prices. So ultimately, the condition that I'm trying to describe is we've got a energy constraint in the system and a slowdown in GDP. That is what it looks like. That is what's happened in the 1970s. Today, it could be happening worldwide. It could be happening worldwide. And what we're seeing is we're starting to see breaks in the system with energy and constraints. And what I mean by breaks, there's things that are happening where energy is not flowing around the world continuously. And we can see the reaction and the outcomes in certain countries and the problems that they're facing when energy becomes a problem. It's basically a test run in the world. So is this peak oil? I don't necessarily know, but I can tell you that the world's it's very close to bumping up on spare capacity, where we're basically at pumping capacity of the world. We're getting very close, and I'll show you later some signs of that. And just for your information, so you guys understand this and kind of what we're talking about, to get a little bit better understanding. This is the historical and forecast oil production in the Midland sub-basin in West Texas. This is just an example so you guys can understand what's going on. This is production from existing wells in the blue color. If you notice, whenever this goes up, right, from the existing wells, you're going to see a decline rate. That decline rate doesn't go away. What you have to do if you want to produce more is you have to produce from future wells in the future. This has to go higher in order to offset the losses or the declines in existing wells. We've already hit and high graded all of the best oil in the world. And what you're seeing is you're seeing technological improvements versus a decline in natural production. Now, keep in mind, the higher you go in production, the further the decline is on an absolute basis. So 6% of a small number is not a big deal. But if you get to 100 million barrels and your decline rates are 6 or 8% or something like that, that means that you have to replace 6 million, 8 million barrels every single year to stay flat. To stay flat. If you want to grow at a few percent, what that means is that you're going to have to grow at a few million barrels above and beyond staying flat. So maybe it's 8 plus 3, and you need 11 million barrels to find in the world to offset the declines and a 2 or 3% growth in production of oil. Do you think that we can add a Saudi Arabia every single year? I don't think so. I think it's going to get very difficult to do that. And this is what it's facing. You're facing the declines, and a few years out, 3, 4, 5 years out, this is what you have to replace with new production. It's the majority of the existing production that's out there. In 4 or 5 years, do you think that we can replace the majority of existing production in oil? I'm not exactly sure about that, and I don't think so. But moving on, just so you guys understand that concept of how hard it is to increase the production of oil from a very large production base and growing at exponential speeds. We will hit a wall at some point, and I don't know when that point is, and we won't know the problem very much. We won't know a lot of lead time before we hit that wall because we're moving at exponential speeds. Now, here's the gold to oil ratio chart. This is what I use to buy my oil. More or less, it's an inflation-adjusted price. In 1970, you would have bought it at a ratio of over 30. You would have been a smart person doing that. That compressed all the way down, and we paused in the middle about 15. We paused for a little bit, through a little recession. We paused. It didn't go back above 30. We paused in the middle of that recession, and we came down. So we went from above 30, compressed it to about 12 or 13, came back up, and then went all the way below 10. This is what happened over here. A gigantic anomaly in history where oil was never as cheap as it was against gold, ever. The average here is about 15. That's the average. We're heading on down. We're at about 16 or 17 right now, and we're pausing, just like the recession in the 1970s. We're pausing at that number, and we're probably going to head lower below 10, maybe even way below 10. We'll see. But that's the gold to oil ratio chart. We had a buy point in 1970. If you were smart enough to take advantage of that, you made a buttload of money, a buttload. Looking at crude oil prices, this is the price, not the ratio, but the price. In 1970, it was $3.50. It went to $40 a little bit before 1980. That's a 12x or whatever increase. We had another very large increase where we were priced in the teens all the way to 140. Another 10x, 12x or so. And we went to a very low level in 2020, and we're probably going to go to a very, very high level in oil. This here is inflationary every time this oil price goes up. Whenever we hit problems in oil, it is inflationary. That inflation transfers to the consumer price index. The consumer price index goes up, interest rates follow usually behind it, and then money starts to rotate differently in assets. That is the order of sequence. Higher oil prices, interest rates follow or follow very closely with it generally. And then you see a CPI print or a CPI, interest rates, and then money rotates differently. During the 1970s, we had a large demographic come through, their population demographic came through home buying years, which added liquidity into the system. There's your recessionary pullback in the housing market, and then another liquidity boom. The population went up and declined during this time frame, and then went back up. It was the population moving this. It wasn't interest rates. It wasn't anything else. It was the population going up and down. And this here added liquidity into the system. We had that same scenario in the 2000s, and we have another scenario coming up today where it aligns very much like the 1970s in terms of liquidity being added to the system. This is showing in the 1970s that we had a lot of money rotate into gold versus the monetary base ratio. And what this is telling us is that money's in the system, but it's not parked into gold. It's parked in other assets right now. And why is that important? It's important to know where the money is at. Because if you're going to front run the money flows, you have to be in the asset that doesn't have money in it. What happens is certain market conditions rotates money around differently. We looked at the 1970s. In the 1970s, this was the move in gold in relationship to the monetary base. Why is this important and why am I showing you this? Because under the market conditions that I think are coming, and under the market conditions that existed in the 1970s, which are very similar to today, we had an energy crisis. We had a population demographic and home buying years coming in and buying homes. And what happened is inflation took off the same time that energy took off. Energy took off, raising that CPI. We had a problem in energy, and this is what happened. When we hit a problem in energy, people are going to get focused. They're going to be, the entire herd of cash in the system is going to go and focus on certain assets because those other assets will go down in value and price and be rotated into gold, precious metals, and energy. So when energy goes short, usually what sells off, because you're going to be in a highly inflationary environment and a rising interest rate environment, much like we are in today, is money will rotate out of bonds. It will rotate out of stocks because stocks will become less valuable. Their cash flows will go down because their margins will get squeezed with the energy costs. And consumers will get squeezed because more money is going to go to energy and living versus consumer products. And house prices will be going up because of an imbalance in the market, at least for some period of time. So what happens is you're going to have these assets go into a stagflation where energy is expensive. A recession comes because energy is forcing it to cut back. We have a constrained energy problem. The constrained energy problem puts pressure on inflation, and that inflation puts pressure on interest rates. And what happens is people sell out of bonds because they got to get out of there. They're losing money. Then they're going to start selling regular stocks because their margins are getting squeezed from energy. Energy and precious metals is the game to play at that point because it has to rotate out of the other assets and go somewhere that's either safe or is trying to solve the problem, which is energy in a crisis. So during this time frame, what we saw is the money in the system started to rotate into gold during those market conditions. That's why we see this ratio go all the way up. Now we're at very low levels. We're at very low levels. And gold is very cheap in relationship to the monetary base at this time. And it takes time for people to figure this out. It's not immediate. So we have the same market conditions that I think are coming up, and I'll get to more on that later here. And the money's not in gold right now. And if those market conditions replay, we could see a large move in gold higher against all these other assets. This is the S&P to commodity index versus stocks. We are coming from an area where the green area is at. 1970 is the green area. Red area was 73, 74, and then it also went up here. This is your dip in the housing starts, and then the smaller boom that came with the housing starts. The liquidity into the system. The demographic drove this. The alignment was there at the beginning of that demographic coming up. The demographic came up, an energy crisis happened, and we had a massive move from 1970 to 75. Right now, we're at the beginning of this big move that is coming. We're at 2020. It's very low. And we have an energy crisis on our hands. And I'll get a little bit more information on that here later, on the energy crisis. But this is when you get and start looking at commodities. And we are at the same type of market conditions as the 1970s as we are today. There's same conditions where money is parked in the S&P 500. It's not in commodities, and money is parked in bonds, which could be the largest bubble of all of them. That's where the majority of money is. We've been in a 40-year decline in interest rates. A whole bunch of money is over there. Now, getting back to energy. If we have, these are projections. This is U.S. dry natural gas production in trillion cubic feet. I think there's an opportunity in natural gas, a big opportunity, because other parts in the world, right now at least, are in a crisis. And this crisis is aligning very well with other things in the system that are going to add liquidity to this system at the same time an energy crisis is happening. This is happening worldwide. It's not happening in one country. It's happening worldwide, which means a whole bunch more money is going to be rotating this time into precious metals and into energy. Now, right now, U.S. natural gas is very cheap in relationship to other European, Asian natural gas prices. The liquefied natural gas market is what connects these things together. Right now, there's an opportunity because the Freeport LNG facility is down, which is 20% of our shipping capacity of LNG. That's what connects us to the world pricing, the United States to world pricing. And right now, there is a problem, which is good if you're an investor. We should be looking at what can be grown in the future, shale gas, and the companies that can produce shale gas. I'm sharing that on the website. If you guys are interested for the platinum memberships on what companies I'm playing for this opportunity, what I think are the best plays with the most leverage. And I'll do a new post on this and show you guys a whole bunch of information on where the liquefied natural gas plants are, who's going to be feeding them, and who I think might have some very good leverage to the price moves. But shale gas is, I think, and tight gas is where the opportunities are in the United States. And those opportunities are there because we've got natural gas here. This is the Dutch TTF. This is natural gas prices on a long-term perspective. Straight vertical. They are moving on up. This is, one thing I want to tell you is this crisis started before Russia. They had a problem before Russia, and Russia is obviously amplifying the problem. But that's the prices there. That does not look normal. This is a total crisis. Natural gas zoomed in. This is on a 1-year time frame. The Freeport natural gas facility went down in June 14th, which is this day here. You notice anything that happened in June 14th? We had a massive move higher, Mr. Finding Value, in natural gas. Correct. That is the correct answer. That here, the link was broken in America, and natural gas overseas is going vertical. It's going up. What happens when natural gas prices go up? Well, we go up in consumer price index. And I know this is a ratio here. This is the CPI to PPI ratio. This is showing us that the producer price index is rapidly going higher. And this is the German CPI. German CPI is in yellow. The producer price index is in white. And what usually happens is the PPI goes up and then you'll see the CPI go up, lagged a little bit behind it. This is what's coming, guys, in the PPI. This is what's following. It's coming on up, the consumer price index. We're seeing these producer price indexes go quite vertical all over the place, even the United States. This is United States natural gas. And one last comment I want to say about this. This is energy driving this. This is driving this. That is what the driver is. Natural gas in America is starting to move. 2020 is when it started to move, 2021. And it's moving with the overall markets here, starting to come up. The LNG facilities are what links this all together, and I think that we're going to see a big move in natural gas, in American natural gas. I even think that we could see a larger move still, even in natural gas overseas. Here's oil, or natural gas on a short term, sorry. Oil on the short, or natural gas on the short term. June 14th, we fell lower. The Freeport LNG facility had a problem, and we went lower here. What's weird is we had somebody who knew about this as it was kind of squeezing up, as it went down a little bit before that problem, almost as if they knew something was coming. Speculation there, guys. A little bit of speculation. Now, here's some information. I just want to share some information here. OPEC Plus has kind of broken down as Russia loses relevance and group faces tight spare capacity. Let me say that again. OPEC has kind of broken down. Oil producers and OPEC Plus have not been able to meet their production targets and have limited spare capacity to increase output, analyst says. The alliance on Thursday said they would increase production by 250,000 barrels per day in July and August to bring output cuts to an end earlier than previously agreed. OPEC and its allies decided to take nearly 10 million barrels of oil market in 2020 when COVID first hit and demand evaporated. A lot of people don't think that OPEC has the spare capacity. They haven't been hitting their quotas. They've been underproducing, and people are continuing to ask them to increase production, and no response. In fact, some areas have produced less from declines of production, like we learned earlier. If we're at world peak oil, and if we're hitting problems in natural gas, the world is at risk of any sort of retaliation from any country not putting barrels on the market. Let's say Russia doesn't want to put barrels on the market. Oil will do incredible things to the upside if they decide to not sell as much oil into the market. OPEC doesn't have the capacity that we think they do, or at least what we thought they used to have. If they don't have that capacity, we are going to be at pumping capacity of the entire world, which we've never been at. The entire world, not just the United States like the 1970s, the entire world. Now, right now, this is what they're doing. This is the actions to immediately increase supply and lower prices at the pump. The largest ever release of oil from the Strategic Petroleum Reserve. President Biden announced the largest ever release of oil from the Strategic Petroleum Reserves, which will put 1 million additional barrels on the market per day on average, every day for the next 6 months. The release will provide a record amount of supply to the market until the end of the year, when domestic production is expected to increase by 1 million barrels per day. DOE will use the revenue from the release to restock the Strategic Petroleum Reserve in future years. This will provide a signal of future demand and help encourage domestic production today, and will ensure the continued readiness of the reserve to respond to future emergencies. Historic collective release of oil from the International Energy Agency. After around-clock diplomacy by the president and allies and partners, the International Energy Agency announced an unprecedented collective release, with member countries outside the United States releasing an additional 60 million barrels. Together with the United States commitment, this will add a combined global amount of 240 million barrels to the market. It is the largest release from other IEA countries in history and will support American consumers and the global economy. We are releasing the largest concerted effort to suppress the price of oil by releasing these inventories. And this is what it's done to the oil price. This right here. It started here, and we had some pullbacks in oil. This is what it's done in oil price. The largest concerted effort in the history of mankind to suppress the price of oil, and we're still above $100 a barrel. Interesting. Remember the 1970s market conditions where oil went ballistic and gold went ballistic because of those conditions, because the money, the liquidity in the system was transferred into inflation through the oil price. Interest rates chased it. We had stagflation. And where did the money go? Went to gold, platinum, silver, and energy. The 10-year Treasury rate. This is your interest rates. 1970 was your problem right here at the beginning of 1970. What happened to interest rates? Bam, 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 up. Larger demographic, more liquidity in the system, and an energy crisis at the same time. What's happening to interest rates? We had everyone and their mom get crowded into gold and energy and commodities at the top of 1980. That money's now rotated because of interest rates coming down in a 40-year decline, which was demographic driven, all the way to the bottom. We are starting to come up in this interest rate to the upside. And they're holding the interest rate down through not only quantitative easing, which they were doing, but now they're holding it down through the suppression of oil. Remember, oil and interest rates and inflation are all tied together. Now, my question is this, guys. What do you think is going to happen when they run out of these reserves? What do you think is going to happen? Oil is going to go way higher. This is like a rubber band squeezing it back, and it's going to be slingshot higher. What happens to the consumer price index in America as we build more liquefied natural gas plants in America to export our natural gas to world markets? What you're going to see is a convergence, just like we saw by them diverging when the LNG facility went down in Freeport, 20%. We saw the price of Europe go up and the price of natural gas in America go down. What do you think is going to happen when that facility goes back up and we build more liquefied natural gas plants here in the near future? Well, you're going to get a convergence of the world price to American price. American prices go up, world prices come back down. So where do you think the opportunity is? American natural gas producers and oil that is in exporting countries. And if you guys want to learn more about what those opportunities are and what the best companies are, I talk about it on my question and answer sessions for the Platinum members on the website below in the description link. I'm also going to put new posts so you guys become educated on all of these potential ways to play this. The opportunities are in front of us. A lot of people are scared. Fear in the markets is opportunities for those who are patient and educated in these market conditions, in ratios, and in history. When that SPR release worldwide, we've got till the end of 2022 where this kind of basically draws down. Will they do additional SPR releases? That is unknown. And they can only do it for as long as they have inventory. But as people figure this out and realize that the driver of the problems is energy related, that's when the money starts to flow massively, starts to really start to rotate in. Now, this doesn't mean that this is all going to happen at a snap of a finger. It's going to take some time to rotate. It's going to take time. Right now, there's a lot of fear in the market. There's selling pressures in stocks, and we're going to see further selling pressure, I think. We could be linked up with that, with the leverage in the system, and commodities could still sell off. In particular, energy. The opportunity, in my opinion, is in energy, and I'm getting very excited about the opportunities that could potentially come with buying opportunities. So, again, if you're interested in joining the website below, the Platinum membership's the one that I offer, and you can see those opportunities that I'm playing. You can see my portfolio, what I'm overweighted. And if you guys like this type of analysis, give me a thumbs up. But that's all I've got for today, guys. Let me know what you think in the comments section if you like this type of information. And we'll catch you next time. This is Finding Value.